if you are somebody that likes to, like, let's say you're somebody that likes to do iron condors or iron flies or whatever the duration is, and you're somebody that likes to purchase wings, whether they're $10 wide or $20 wide or $2 wide, whatever it is, and whether it's high implied volatility or low implied volatility, whatever. What this is a in-depth, something like I've never seen this much research done for this, to get into the smallest detail about which wings to buy, which wings are optimal. Like, is it better to go wider? Is it better to go, longer? Is it better to do certain things in high implied volatility? You can use this as an evergreen piece for a long time because there's so much content in here that if you are a wing buyer, now, Tony maybe more so than me, buy wings, mindful and demure. Yes.
That's right.
But I guess my point here is there's a ton of content. We'll go through it relatively quickly, and you can feel free to go back to it because I can't break down every little piece of this. It's just too much. So for part one, we explored the risk-reward dynamics of selling naked options using various metrics. Generally speaking, selling naked options, when selling naked options comes higher risk, but offers greater profit potential. In contrast, creating spreads with further out of the money long options, what it happens is it reduces both the risk and your profit potential, and also the capital that you have to outlay. So traders then can choose between strategies based on risk tolerance and market outlook. We want to reduce the amount of capital we have in play, which right now, by the way, is very low because we just rolled a lot of positions and we covered a lot of earnings trades that we had open. When we go into earnings cycle, our amount of capital usage is usually high, so we will spread more stuff off into defined risk than normal. Once we get through the earnings cycle like we are now, we tend to do the exact opposite and do more strangles because we don't, we have much more cash available. So how can different IVR environments influence your option strategy decisions? And how can using out-of-the-money spreads with naked options help reduce delta and reduce directional risk? Okay, so we're just going to spread stuff off. So this is a 14-year study, and we're going to use 30 delta options, 45 days to expiration, managed at 21 days. We're going to compare the naked put to buying the wings. Okay, buying wings at $2, $5, $10, $15, $20, and $25 wide, compared to in different IVR environments as well. And then we're going to record a lot of stuff. The average credit we collect, the win-loss in dollars, the largest profit, the win rate, the CVAR, the standard deviation. We're going to give it to you all. You're going to be overwhelmed with details in this piece, which is why I said later on, you'll want to go back to it because it's not possible to remember everything. This is the first of many, but this table illustrates how the different matrices, just in this case, or the different metrics, behave to different delta of long wings in low IVR. This is low IVR stuff. As the delta of the long wing increases, what happens to all the metrics, okay, in low IVRs? This first slide basically takes you through kind of all the metrics of different wings, okay, from no wings to $2, $5, $10, $15, $20, $25, and then takes you through all these different categories, which include win rate, largest profit, worst loss, CVAR, and so on. And as you can see here, as you break it down, there's nothing that jumps off the screen that says, oh man, this is significantly better or worse than anything else.
Sure, I got to do it this way.
What it does is, there's nothing that says you got to do it this way, except that I think that in low IVR, you're going to see that in low IVR, generally speaking, you're going to probably not want to do you're probably going to want to do a wing rather than no wings, because in low IVR, there's the least amount of opportunity. So you want to save your bullets for when there's the most amount of opportunity.
Sure.
Okay. And you can go through all the numbers here. If you go to the next slide, we just flip the cards over a little bit. And, hold on. Before we get there. So we observed that in low IVR, as the delta of the long wing increases, the win rate remains consistent. It always does. The profit potential is highest without a wing, but comes with the highest loss and risk, and also decreases as the wings get tighter. So the worst loss and the CVAR drops significantly with wings reducing downside risk. And that's why I think you have to do wings in low IVR, if you're going to use them at all. And the standard deviation and risk reduce with larger wings, leading to more stable returns. And the skew here, wings improve return distribution, meaning that it reduces your risk in the swings and it reduces the negative tail risk, which is, that's what you're really most worried about when you have the least amount of chance to make money. You want to take the least amount of risk, because we flip the cards over here, and this table shows how all the metrics, they're different and they behave in high IVR with the long wing. So this changes everything. It kind of flips the cards over. And you can see here, these are all the same statistics. I mean, they're all the same breakdown in the graph, but the numbers go up dramatically. If you take more risk here, you make more money.
Okay. I mean, that's the way the math model usually works, right? You take more risk, make more money.
Of course. But the argument here is that if you're going to do something with no wings, you'd probably be better off doing it in high IVR. Okay, and we'll show you why. Go to the next slide, John. So with the comparison between low and high IVR, we observe that the win rate sharply decreases with higher IVR, indicating that a small drop in success rate slightly decreases. The largest profit increases significantly. This is the key. The largest profit increases significantly across all deltas, suggesting more potential for profit with higher IVR. That's why I said you take more risk when IVR is higher. The worst loss also decreases significantly. So you're always going to take more risk when your best profit and your worst loss both go in your favor, showing improved loss control in high IVR conditions. The CVAR is going to increase, reflecting a higher potential for large losses in high IVR, and the standard deviation is going to increase a little bit, and the skew is going to be less negative, so it's more favorable in high IVR. We're going to keep going because there's a lot of stuff in here. Now, in this slide, what else will we show in low IVR? So we're going to look at kind of like the average P&L, the credit collected, and the worst loss. And this is all in low IVR. And like we said before, in low IVR, your worst loss is going to go up, your credit collected is going to go down, and your average P&L, it's going to be okay, but it's probably not worth the risk. So you're going to be the most conservative in low IVR. And again, you can go through all these numbers because we posted everything here. This piece took like forever to put together, just with all these different tables and metrics. This is where we talk about high IVR. So that's IVR over 30. And in this case, the average profit decreases significantly with higher delta wings, meaning that if you get too tight, you kind of kill the whole purpose of that. You kind of kill the whole advantage of high IVR.
Sure.
But if you keep the wings wide, it makes you do significantly better. The credit collected, if you keep the wings wide, is going to increase, and the risk, the worst loss case, decreases considerably by as much as 65% because you're collecting more premium. Like I said, there's a lot here. Again, as we mentioned in part one, there isn't a clear-cut distinction between a good and bad wing to choose, but your choice may be guided by your desired trading outcomes. So if you're looking to incorporate wings into your trading strategy, it's worth considering the $5 wide wings at a minimum as an initial option. This choice provides a slightly lower profit potential compared to naked strategies while also reducing some of your maximum risk. You can always adjust your approach on a trade-by-trade basis if there's any changes in kind of your risk tolerance. So the wider you go, the more risk you take, the more money you can make.
I mean, that's a good thing. That's what you want, right?
Yeah, of course. Typically, the decision to purchase wings involves striking a balance between maintaining a short-term portfolio stability and potentially sacrificing long-term profitability. So as we mentioned, high IVR provides the optimal performance across the board, but has to be mechanically managed. That these things, nowhere in the active trading space do things manage themselves. You don't do considerably worse if you don't manage, but you don't pick up that edge. Like if your only edge that turns it away from a zero-sum game is your ability to manage, then you have to manage. Because otherwise you're going to end up very close to a zero-sum game. So the beauty of management is that's the one edge that's the one edge that you have. However, purchasing too large a delta can result in nullifying any profit. That means if you sell the 25 delta and you buy the 23 or 22 delta, you're probably too close. Or the 24, like if you go $1 or $2 wide, you're not really getting the edge of the high volatility because you're buying high volatility against it.
Sure.
You want to go wider where you give yourself a chance to make some money.